Alrighty, here we are with lesson 3, and we're looking at chapter 14, I believe. And I think that the normal payables are fairly explicit. The notes payable, the mortgage payables, I think those are fairly easy to understand. What I think you will have a little bit of stumbling on will be the bonds payable. And that's what I'm going to go over in this overview. So let's describe what the heck is a bond and why is that different. Well, a bond's a long-term debt, okay, and it's issued to several lenders, and they're called bondholders. Imagine that. And they're usually presented or issued in increments of $1,000 per bond. So each bond has a face value, and that is the amount the borrower must pay back to the bondholders on the maturity date. You being the borrower. Now, does that make sense? You're issuing these, and you are borrowing money with this bond payable. So you've got the face amount that will equal the maturity amount, that will equal the principal amount, that will equal the par value. So all of these, all right, are kind of synonymous with each other, or they are synonymous. This is the face value. The face value will always be the maturity value if it goes full term. This will also be the principal amount, okay, and it's also called the par value. So on the next screen, the maturity date is the date at which the borrower is going to pay the principal amount to the bondholders. So you have a stated interest, and a stated interest rate is what determines the amount of cash interest is going to be paid for the bond each year. Now, typically, interest payments are made every 6 months, so they're semi-annual. So you have the stated rate, that's also the face rate, the coupon rate, or the nominal rate, which is stated rate. And that's really important with a bond, because a bond will have a stated rate, but then it also has a market rate. And the market rate may require adjustment of the amount or the proceeds that you get from that bond, which I'll explain here in a second. And a bond, in a physical sense, looks like this. It tells who's lending it, or who's borrowing. It shows the maturity date. It shows the face value here, and it also has the stated rate of interest. Now, these all get printed up, so there's a lot of money that goes into preparing to let bonds out. Types of bonds are, you've probably heard this before, term bonds, they all mature at the same time, or serial bonds, which means they can mature in installments, at regular intervals. You have secured bonds, which are secured by an asset of the person who you're lending to, who you're borrowing from. And boy, that's a tough one for me for some reason. A debenture bond is an unsecured bond that's only backed up by the creditworthiness of the company who's issuing the bonds. And you'll see those a lot as long as the company has a really good credit rating. And now let's look at the bond prices, and this is where it can get confusing, and why I wanted to explain this a little bit more fully, because it can get really very, very confusing. Remember, we talked about the face amount, the face value. When a bond is selling at par, it's selling at that face amount. But sometimes a bond will sell at a discount, which means it's going to sell or be issued at less the face value here, or it can sell at a premium. And that would mean it would sell above the issue price, okay? Or the issue price would be above the face value. So let's kind of keep going. We can give you some examples And first of all, that was the stated amount or the face amount, the value of the bond. Also look at the bond interest rates. So we have the stated rate, which is on the bond, but we have the market interest rate, which becomes really important in this whole scheme. This rate never changes here, but the interest rate does change right here. If I can bring this up, I'm going to blow it up so you can see this a lot better. So here you go. You don't have to be squinting. So stated rate does not change, but the interest rate, market interest rate does. So when the stated rate and the market rate are the same, the face value of the bond is what's stated on the face of it. Okay, that's the face value, is what the bond is issued for. When the bond rate is 9, but the market rate is 10, then we have an issue, because if the market's at 10, nobody wants to get a 9% bond. So you're going to have to discount that face amount to compensate for the differences in interest rate. So the discount rate will be the difference, theoretically, between the 10% and the 9%, but the bond will still return a 9% interest payment. But it will sell for less, or it will be issued for less than the face amount. Now, let's reverse that. We have a 9% bond, but the market rate is at 8%. So the bond's going to sell for a premium, which means more than face amount. Because, i.e., if I were a borrower, if you could get a market rate of 8%, why would I want to pay 9%? So to compensate for that, or to make it to adjust that, the bond will be issued at a higher face value, and that will take up for the differences in those interests. Let's keep going, and I'll give you an example. And then they talk about, and we do an activity with this. Why would you issue a bond if you could issue stock and not pay interest? Well, some interesting things happen with this. Okay, a lot of times debt is less expensive source of capital than stock, and doesn't affect ownership percentage. Now let me show you what we mean here. Here is an example. Okay, net income before the new project is $300,000. We have two scenarios. I can issue a $500,000 bond, or I can issue $500,000 of stock. So let's just compare it. We expect the income from that new project to be $200,000. The interest that we're going to pay each year is $50,000, so we'll have to deduct that. So we come up with a projection of income from borrowing the money of $150,000, and we have to take away the tax expense, obviously. That leaves us with a projected net income of $90,000. All right, and here then we have the net income from the new project added into the income overall, and that comes to $390,000. Now we're always worried about earnings per share, because that's how our that tells us how much our stockholders are earning, and that's why we're in business. If we look at the earnings per share, that's $3.90. We have 100,000 shares divided into 390,000. Now let's go look at if we issue common stock. So I've got the same numbers. I'm going to have the same income here, but I'm not going to have any interest expense, right? But I am going to have a tax expense, so that needs to be deducted. And I show a net income from the project of $120. Well, you think, well, hey, look, it's more. Well, let's go with the issue of the stock. But you can't do that because we haven't tied it all the way down yet. We also have to look at the earnings per share. And look what happened. We increased our shares by 50,000, and now my earnings per share are only $2.80. So which project do you think they're going to do? They're probably going to do this one because the earnings per share are higher. So that's why sometimes they will issue and increase liability rather than increasing stocks or stockholders' equity. So how do you account for this? So accounting for bonds payable and the interest expense. Now this is interesting. There are several things you have to look at. The first one, you have to look at the data. You have to know if it's face amount that you're dealing with, a discount amount, or a premium amount. Okay? And you have to remember bonds are long term. So let's look at the first one they give us. They give us if we issue it for a face amount, that's a no-brainer. You're going to have $1,000 in cash, and your bonds payable is going to be $1,000. Your interest expense is going to be $4,500 for the first payment and $4,500 for the second payment. So it's $9,000. There is no account that's going to be a contra account or an adjunct account to go against that. So on the balance sheet, it's just a payable, bonds payable of $100,000. Now, it gets complicated when we start looking at different interest rates. First of all, we've got a 5-year bond at 9%, just like the one above, but now the market rate is at 10%. So what ends up happening after calculations to compensate for the differences in interest, they find out that they're going to receive $96,149 instead of that $100,000. So, so I'm still going to record that bond payable at $100,000, but I'm only going to receive $96,149, and that has to, and that will have to show a discount right here. So that's how we balance that out. So now, I've only received $96,149, but I owe $100,000, and I have a discount that I have to take care of. And that's where that amortization comes into play, where we're going to divide that equally over that 5 years, and I'll show you what we do with it. So now, we've got a discount on our bonds payable, and that's going to affect the carrying value of the bond. It's actually going to be $100,000 minus the discount. But here's how we create that straight line amortization of the bond. It's just like depreciation. Okay, you're going to divide it by the years or by the period. In this case, it's 5 years or 10 periods. And it's going to be $4,500 paid, but we're also going to have the amortization divided by that 10-year period. So it's $3,851 divided by 10, or $385 each time we make a interest payment. So you'll have a little schedule to go by. And this is what you end up with. So the first payment comes along. We're going to pay cash of $4,500. We're going to pay that 9% no matter what the market rate is. We are going to apply, which means we're going to take some of that discount and amortize it now, which is going to increase our interest expense right here. So that gets credited, and our interest expense gets debited for, instead of $4,500, it gets debited for the $4,885. So it's compensating, okay, as if we were actually paying the 10%. So that's a discount. Now, this is a premium, and that's just the reverse, okay? So keep that in mind. We're just reversing what we're doing now. So now, the bonds are at 9, but the market's only paying 8. So we've got to compensate. Again, I want to rewrite the whole thing, and we're not going to do that. So instead of receiving $100,000, we're going to receive $104,100 to make up for the difference in this. So we have cash of $104,100, and now I'm crediting a premium. I credit the payable, but I also credit that premium for $4,100, sorry. So then you come back and you're going to do that straight line amortization for 10 periods. So 1/10 of 4,100 is 410. So now what have I got? I'm paying $45,000 in cash, right? But I'm only recognizing as an interest expense $4,090, and I'm absorbing some of that with that premium here. So, and you'll do that each time you make an interest payment. So premiums and discounts are just a way of being with a bond because the market is always moving. So you need to kind of understand this concept of premium and a discount. Not particularly care if you understand the journal entries, but understand where the amounts come from and what the amounts are. So there's one other thing we should look at as we're in here is how do you retire bonds once they're paid off? The easiest way is if you get all the way to maturity. There you go. You're going to lay out the cash for $100,000 and bonds payable for $100,000. Now, if you notice, as you're moving up with a premium or moving down with a discount, that's moving your bond closer to that $100,000 even payoff. So, now what happens if they do it before maturity? Now, this is kind of interesting, and this shows you the relationship of the discount. So we have a bond that's going to be retired early at $100,000. The discount is sitting at $3,081, which means I have a carrying amount of $96,919. I'm paying it off at $95,000. If it went to maturity, I'd have to pay off the full $100,000 or whatever was the discount deducted. I'm getting off $1,919 to the better. So I have a gain on my retirement of the bond, which you will have. You will show those, a gain or a loss. And it would be recorded like this if you were doing recordings, but this is how it's figured. So bonds are fun, okay? I think we'll stop at that point. I will look at how to record liabilities on the balance sheet next. I think we need to include that. So, see you in the next video.